how to use moving averages as part of your trading or investment strategy. And I'm going to go through some examples in this video. So we're going to get some moving averages on our chart. So I'm going to go to indicators and then type in moving average. This is TradingView. It's free, so go ahead and use it if you want. I'll link them below as well if you want to get there, but it's moving averages. And I'm going to show you the difference between a simple moving average and an exponential moving average. So moving average simple, and down here, moving average exponential. I put both of these on the chart and we have 50 periods right here. That means that we are taking the 1 week chart, because I'm on the week chart here. So 50 weeks. 50 weeks of price data is taken. You take the average of that, you plot it on the chart, and then over time with each new week, you get a new piece of data and you chuck out the data that was 50 weeks ago and you get the latest week. You plot that over time and you get a line that smooths out the price movements in the chart. Simple and exponential. The difference here is that exponential moving averages place more weighting in the calculation to recent prices versus prices that happened 50 weeks ago. So if we take away the price chart right here, what you can see is that there is a slight difference in the way the data is presented. I don't personally believe that this difference is big enough to influence trading strategies. People have their own opinions about this. If you are trading shorter term and you want more weighting on that, maybe use the exponential. For me, simple moving average works, and so that's the one I use. What we're ultimately looking for when using moving averages is trends. So which way is the trend? How can we identify that trend and use the moving average to actually trade? So there's two bits of information here. The first is the moving average, and the second is the actual price of the asset and where it trades in relation to the moving average. The moving average is the longer term trend that we're looking at. The very short-term price action that trades around that is something that we can actually trade, because when there are discrepancies within a trend, that is a tradable event. Most of the time, people will be using the 20, 50, and 100 period moving averages. So what I'm looking at here is moving averages of the monthly chart. So I'm looking at 20, 50, and 100 months worth of price data. If you go down to different types of chart, for example, a 1 day or a 1 hour, you'll be looking at 20, 50, and 100 periods of that 1 hour chart. So 20, 50, and 100 hours worth of data. Of course, the longer the time frame that you're looking at, then the data is a lot more reliable in terms of the longer term trend. So firstly, what we can see here is that the moving average very clearly shows this asset is in a big uptrend, because the price data is showing that over time, the average price traded for this asset is going up. In fact, this asset has essentially had no downtrend whatsoever over the longer term chart. The blue line is the 50-month moving average and the 100 is in yellow. So this asset essentially has had no downtrend. We can very simply then use moving averages to identify trends, uptrends or downtrends by the direction of the moving average. We now need to put the price chart on here to give us more information. So when the price chart is moving above the moving averages like this, then the price is very clearly within that uptrend. You can see that the price does move down over short time horizons or low time frames, but there is no rejection of this trend. Each of these pullbacks is just being met with more buying, pushing us further and further into this uptrend. That is something we can trade. We can trade an uptrend and we can trade pullbacks to the uptrend where we actually bounce further to the upside. Now, if we look at downtrends, you can see that that's when the price action, the actual price, is tending to move underneath the moving averages and getting rejected from them. So you have a downwards price trajectory, you come back up into the moving average, you get rejected again. You kind of recover and you get rejected. So clearly a downtrend here. The other thing that you can see is that moving averages are lagging data. They lag the data, which means that we can't use them all the time as indicators to trade because they are lagging what's really happening. So we can't just trade moving averages. We have to have a coherent strategy of what we want to do. And so I'll go through some trading strategies around this right now. But uptrends is when the price action is moving above, downtrends usually when the price action is moving below. And of course, when the price trades around these, we can make decisions about trades as well. You can see that when the price breaks down from these moving averages, what we're seeing potentially is a trading opportunity where we know short term what is happening to the price. You are going from an uptrend and potentially breaking down into a downtrend. And so that's a trading opportunity. We can also see that here where we did have a downtrend, but the price moves through both of these moving averages, indicating a potential change in direction. And so again, this is an area where we can trade, where we have confirmation between moving averages, which are lagging, and price data, which is obviously indicating what's happening right now. Where there is a crossover or a change, they are trading opportunities. And so you can make trades based off of that. Let's go through some examples. The first strategy is very simple and relates to investing in assets that we want to accumulate over time because they're rising in value. So the way that we can do this is just look at a longer term moving average of an asset that we want to accumulate. For example, Bitcoin here, if we take away the price chart, what you can see is that essentially over time, the moving average is just moving up and to the right, essentially gaining value. I'll just change the color here so you can see it more clearly. But we have a price that is over time moving up. Now, the price of Bitcoin is extremely volatile. So if we, for example, buy each week or each month, because we're on the month chart right here, then our portfolio would be a moving average of the price because we're dollar cost averaging, making our cost basis, our purchase price for the asset, exactly the same as the moving average. If our portfolio looked like this over time, we'd probably be quite happy, right? Because our portfolio value is moving up over time. So we can use moving averages as an example of what we want to invest in. If our portfolio tracks the growth of the asset and tracks the moving average, then our portfolio would grow with it. So we, as an investor, can essentially invest in assets that are growing and use moving averages as an example of what we would want to do. Simple, straightforward, and very passive. I'm going to go ahead and trade on my platform, which is Bybit right here. So each week or each month, you put in a purchase order of an amount of BTC, you buy that, and your portfolio becomes the moving average. And as you can see over a long time horizon, that's what your portfolio would look like. That's the easiest way to invest over the long term and grow the assets that you have under management. The second strategy is to be a little bit more active here and try to outperform the market, which I'll show you. If you don't want some deposit bonuses, if you do trade crypto, check the links below to the exchanges I use. You can get some deposit bonuses on those. What I'm going to do is go back to the price chart right here and put this on. So a more active strategy would be to, of course, identify a trend and then trade when the price is relatively cheap in relation to that trend. So we have a trend here with BTC, and this is the price. It's very clear when we look at the 50-period moving average that there are areas or times when the price of Bitcoin is fairly cheap in relation to its overall trend. In fact, the price of Bitcoin moves above this for the most part, and of course it would because it's an uptrend, and therefore the price is moving above, dragging the moving average up over time. However, there are shorter time periods where the price is in a bear market or is in a drawdown, people are selling. Those are periods where you are going to get prices that are fairly cheap in relation to the overall trend. You can see that there are a few areas right here where the price is very cheap in relation to the overall trend. The price actually comes into its moving average, and each and every time has then rejected to the upside and bounced off because the trend continues. So the trend is continuing. If you want better prices, you wait until you get these opportunities. Now, that's a trading strategy, again, fairly long term. But what we can see here is that if you want to make returns, you have to be buying during those periods, even if it feels very difficult to do so at the time, because these periods are when FUD is the highest. But we can see that very clearly they're the best times to buy. So to be more active, you have to be active when prices are cheap in relation to the uptrend. Now, if this thing was pointing down, of course, you'd be selling anytime that the asset bounces into its trend and then gets rejected again. That would be a downtrend. But if you believe that the asset that you're holding is in a downtrend, you sell the whole thing. You don't wait for bounces. So that is how to be slightly more active when investing and try to outperform the moving average and get better prices for your trades. The third type of strategy is to be even more active and look for crosses of the moving averages or crosses of the price above or below the moving averages. So essentially what you're trading here is a change in the trend. Again, for Bitcoin, so we've seen that the longer term trend is to the upside. However, we do also know that we get bear markets or areas where the price is moving down. And so these are trading opportunities as well. An example of this would be the last bull market moving into the last bear market. So the price is moving up very clearly above the moving averages here. So an uptrend. We get a sell-off and another bounce. So we're still in the uptrend. We're still moving above these. However, you can see the price does start to move below both of these moving averages. We're on the 50 and 100 period. The 50 period is a lower time frame, or has a shorter time frame, and so is more noisy and not as predictable. But if the price moves below the 100 as well, then you're starting to get a real sell-off in the asset. So as the price moves down below the 50, this is potentially an area where we can say the uptrend has maybe finished, is rejecting and becoming a downtrend over the short term. We can also see that the price moves back up into this trend and gets rejected for a second time. What we're seeing here is a potential downtrend where the price is rejecting and not moving in an uptrend anymore. We then get the price breaking through the longer period moving average, another indicator of a downtrend. So we are seeing a breakdown in the price. If you're a short-term trader and you want to take advantage of this, you could say, hey, the price is weak and it's moving in a downtrend because it's broken through all of these moving averages. Maybe this is something I can trade. So what do you want to do? Or if you had Bitcoin, maybe you sell some if you want to do that. Or you can, of course, trade long and short using futures. This is more for advanced traders, right? So you can open a long or open a short. That's where you take advantage of prices going up, long, or going down, short. This is for more advanced day trading. You don't need to trade the asset at all. You just trade the price. But you can see that that's a trade that could take place, a breakdown of the trend and something that is tradable. Now, this is short-term trading because the asset itself is in a much longer-term uptrend. And so what you're doing is going for the small odds. The odds, if you want to win, the odds are to just buy and hold it and wait for the performance. We've seen that over 15 years it happens. If you trade, though, you're playing much smaller odds, but there are opportunities here. Now, as the price moves back through these moving averages, you can see that that downtrend that happened is now rejecting again. We have a breakthrough of the 50 period moving average. Then we have a breakthrough of the 200 period moving average. And we have the two moving averages breaking through again, right? So that shows that we're potentially in an uptrend. As you can see here, using moving averages to trade can help you out. However, they are lagging indicators. The price moves through them much earlier than the moving averages move. So if you want to wait for the moving averages, you can do, but you may be late to the trend. It's also important to understand that we can't just use moving averages. We need to understand what period the market is in. We need to understand, are we in a bear market? Are we in a bull market? A lot more fundamental analysis that we should do before trading, of course. We can't just use lines on charts. They're not going to give us the real information. We have to have experience with that. As you can see, we can definitely use price moving through moving averages to confirm any analysis that we do. If you want to trade on Bybit and the other exchanges I use, I'll link them below. If you want to get more professional, I'll leave some free guides down below, the Crypto Investor course down there as well. You can ask me questions in the Discord groups. I'm James, it's Money G. Cheers for watching, and I'll see you in the next one.